Silicon Valley Bank, the 16th largest bank in the U.S., was mentioned in an article titled America's Best Banks in Forbes magazine on February 14, 2023. SVB was ranked number 20 on the list. A banking crisis developed in only a couple of short weeks, and the bank quickly went bankrupt.
SVB, the 16th largest bank in the U.S. with $175 billion in deposits, is now the biggest American bank to fail since the 2008 financial crisis.
This is the second biggest bank failure that's ever happened in the United States.
Silicon Valley Bank was the 16th largest bank in the U.S. It took just a day and a half for it to fall apart.
How could a bank become broke in less than a month after being named one of America's best? What comes after that? Will there be another financial catastrophe after this one? Stay with me until the end because this whole story is wild. This is something you shouldn't miss. Let's get into it. We need to know what caused this crash in order to fully understand its effects. Silicon Valley Bank, also known as SVB, was not your typical bank. It was the go-to place for venture capital and tech startups. The tech sector experienced healthy growth during the 2020 pandemic, when low interest rates and excessive money printing by the U.S. Federal Reserve led to a boom in the technology sector. At the time, investors were kind, and startups were able to raise money easily thanks to cheap credit. However, once the companies had that money, they needed somewhere safe to store their money. This is where SVB came into play. Who would have known that one of America's best banks would go downhill so quickly? Let's keep unraveling this crazy story. SVB experienced a significant influx of deposits in 2020, going from about $61 billion at the end of 2019 to about $189 billion at the end of 2021. Now that they had so much cash on hand, SVB sought to increase their profits, and long-term bonds seemed like a secure bet to do that. These are typically regarded as safer than stocks and offer a consistent return. Wait a second, how did a safe investment such as bonds cause the downfall of Silicon Valley Bank? Let's find out next. So here's how bonds work. When interest rates are low, freshly issued bonds have lower interest rates or returns, which make the existing long-term bonds higher paying returns more appealing. This increases the price of these bonds and increases demand, resulting in a profit for the owner of these long-term bonds. As soon as SVB became aware of the opportunity, they placed $80 billion of their deposits from the tech industry into long-term bonds and other securities. And if clients want to withdraw their money, SVB just has to sell a portion of their bonds at minimal losses in order to return the funds to said client. But wait, what happens when every SVB client requests a cash withdrawal all at the same time? Silicon Valley Bank was about to learn the consequences quickly. The effects of the 2008 financial crisis and its aftermath are being felt today, and the post-crisis market is unfamiliar to an environment with high interest rates. The risk management team at Silicon Valley Bank disregarded the possibility that higher interest rates could cause hazards in weaker parts of their financial system. The risk management team essentially failed to adapt to a quickly shifting climate with rising interest rates. We'll get more into the details of how badly SVB's risk management team messed up later in this video. You won't want to miss it. Late in 2021, SVB started to experience issues. Inflation in the U.S. started to increase. The U.S. Federal Reserve would typically raise interest rates in these circumstances to stifle the economy and combat inflation, but this time it did nothing. For a while, they claimed that inflation was just temporary, but this turned out to be absolutely false. When the Fed understood this, they had to hastily boost interest rates to make up for lost time. This abrupt increase in rates didn't give the market time to adapt. Let's see how this affected Silicon Valley Bank next. At SVB, the investing climate started to change drastically. The older long-term bonds lost some of their appeal to investors as interest rates increased because the freshly issued bonds started to pay higher interest rates. Due to the decrease in demand, those bonds' prices decreased as a result. SVB was still exposed to risk because they still held long-term bonds worth tens of billions of dollars. Unrealized losses from the decline in long-term bond prices totaled $15 billion by the end of 2022. Normally, this wouldn't be a problem because SVB wouldn't lose anything if they held on to the bonds until they matured, but this wasn't a typical period. This is just the beginning of SVB's collapse. You won't want to miss exactly how this unfolds next. Technology firms were finding it difficult to secure money in an environment with increased interest rates as credit began to decline. These tech firms had to use some of their available cash to pay for operations. Startups made up the majority of SVB's clients, and as a result, deposits began to decline, going from $189 billion at the end of 2021 to $173 billion at the end of 2022. SVB had to sell some of their long-term bonds to pay for each significant withdrawal. The bank had enough cash on hand for a while to handle these withdrawals. The depositors kept leaving Silicon Valley Bank as time went by. This ended up being the start of the insane chain of events that caused Silicon Valley Bank's collapse. Stick around to the end so you don't miss out on what led SVB to bankruptcy. SVB dropped a major bombshell on March 8, 2023. Their entire liquid bond portfolio, which was formerly valued at over $21 billion, was being completely sold off. SVB suffered a $1.8 billion loss on the sale of the bonds. Management chose to raise some capital in order to make up for the losses. Although this seemed like a sensible decision, management made a major mistake because the timing could not have been worse. Only a few days prior, Silvergate, a tiny crypto-focused bank, fell as a result of similar inflation-related problems. If you thought that was rough, just wait until you see what's next. The story does become a little wilder. The more you look, the more concerning the scene develops, especially when individuals started to learn more about this disaster. Investors believed SVB was on the same path. As a result, the SVB stock lost about 60% of its value in a single day. Many venture capital firms urged company founders to withdraw their capital from SVB as all of this was happening, which made the issue worse. Customers had taken out $42 billion by the end of March 9th, leaving the bank with a $958 million negative account balance. The withdrawals were so significant that they caused the internal banking system to go down, which only increased public anxiety. Not only did Silicon Valley Bank have to worry about inflation, their cash balance was quickly plummeting because of the massive cash withdrawals occurring all at the same time. Depositors had a good reason to be alarmed. Only returns up to $250,000 are covered by the Federal Deposit Insurance Corporation, FDIC, in the United States. The problem is that 97 of SVB's deposits exceeded this amount because the bank's main focus was to serve technology companies. Shares of Silicon Valley Bank kept losing value up until the trading was stopped. They attempted to raise funds on March 10th, but were unsuccessful. By midday on that day, the bank began looking for a company to bail them out, but no one wanted to work with them. It was risky because no one knew how serious the issue was. Ultimately, this resulted in the FDIC shutting down SVB. Do you think that Silicon Valley Bank had even an ounce of a surviving chance? It seems that too many bad things happened one after the other. Less than 2 days after the crisis began, on March 10th, all of this unfolded. Management completely failed in this situation since they didn't adapt to the environment of rising interest rates. Yes, the U.S. Federal Reserve was mistaken when they said that inflation was just temporary, but SVB should have had a backup plan in case inflation did continue. Silicon Valley Bank senior management committed a fundamental error, according to Bill Ackman, by investing short-term deposits in longer-term fixed-rate assets. Why would management operate in such a way, then? Could it be that leaders at SVB were not all on the same page about how to correct the issue they were having? Let's see how the chief risk officer took action next. Silicon Valley Bank's top risk officer resigned in April 2022 and wasn't replaced until January 2023. Due to this, the bank went 8 months without a chief risk officer. This was precisely when the downward feedback loop caused by the increasing interest rates was escalating. There was no one in charge of the procedure just when the bank's portfolios needed to be rebalanced to take increased interest rates into consideration. In another sense, the bank symbolized a plane in a storm without a pilot. Just shocking. But it gets worse. At the time of Lehman Brothers' collapse, Silicon Valley Bank's CAO served as the company's chief financial officer. And when you see how dumb the following section is, you can't help but chuckle. The CEO of SVB, Greg Becker, served on the board of the Federal Reserve Bank of San Francisco, which was in charge of overseeing SVB. Immediately following the crash, Greg was ousted from the board. It's interesting to note that the bank's CEO, CFO, and CMO liquidated $4.4 million worth of company stock prior to the bank's bankruptcy. According to an SEC filing, the share transaction was automated and pre-planned. However, it's still unclear whether there was any advance information of the collapse. In addition, bank employees earned their yearly bonuses, which ranged from $12,000 to $141,000 just hours before the bank officially crashed. I won't suggest any criminality, but there's a potential the men in charge were aware of what was about to happen. Hopefully, there won't be any more banking crises to cover in the near future, but if you'd like to see more content like this, subscribe to Top Biz TV today to see more videos like this one.